welcome to the Movie Market Podcast. I'm JR Gondeck, and as always, joined by David Sokolovsky. David, let's kind of jump in and recap what's happened year to date and some thoughts going forward.
Sure. Thanks, Jared. So to start 2025, the year started off on a positive note from a market perspective. You saw both growth and high dividend paying stocks moving higher. You did see volatility in the tech sector to start the year, whether it was on earnings news and you saw some of the names move down, concerns about potential tariffs and retaliation, or just high valuations as we've been talking about into the end of last year and to start this year. So saw a little bit of rebalancing out of some of the largest names in the S&P 500 to the rest of the index. And we also, as I mentioned, saw tariff worries increase some volatility, which, as we talked about, was something we expect to see to start the year and potentially in the first 100 days or maybe 6 months as the new administration is coming in and setting their priorities. If you look at interest rates, they were pretty volatile to start the first part of the year. You had the dollar strengthen again on some tariff conversations, as well as other factors that are driving it, as well as fears of retaliation. And really, if you look at what's happening in the interest rates and the broader market, that could create some potential headwinds if rates stay elevated. On the other hand, if the inflation situation changes, or some of the other things that we'll be talking about shortly, that could create some market opportunity. One area I think that was particularly interesting has been international. We've talked about it for a long time as far as being a sector that could be, continues to be challenged. But at some point, as companies return to kind of average returns, you may see some increase in valuations, both in the emerging market side and developed markets.
If you look at the international, David, right, you talked about the strong dollar. So if you think about the impact of foreign companies that do a lot of business in the U.S., they're taking the strong dollar profits back to their weaker currency, right, on top of very attractive valuations. So at some point, even though some of the international economies might be a little bit stagnant compared to the U.S., a little bit like Japan last year, where a lot of the Japanese companies have a lot of international profits. So despite kind of the slower economy, stocks can perform very well. And, as momentum builds in this area, you always see this with hedge funds and fast money chasing momentum. Well, maybe momentum's finally building a little bit in international. So it's something to watch for this year for sure.
Yeah, and if you look, at the U.S. economy, some of the things that we've talked about over the previous several months, and really no major changes, maybe except for inflation, which is one we could talk about a little bit more. But labor remains fairly robust. You saw 143,000 jobs created in the prior month versus about 166,000 for the average of 2024. So again, nothing really notable, maybe slightly lower. You saw the number of open jobs move lower as well, but as we've talked about in the previous recording, the job cuts expectations are much lower. So in general, business optimism is up and the U.S. economy remains on a strong footing. But we'll see what that means with inflation heading slightly higher, expectations of rate cuts, and as you mentioned, Jared, the strength of the dollar.
Well, David, normally we talk a lot about the Federal Reserve, and it's the first time in years that the Federal Reserve, for the most part, is back page news, right? I mean, they're not front and center. As you said, inflation is creeping a little bit higher. The labor market, for the most part, remains in neutral, not too good, not too bad, right in between. And the Fed market expectation right now is the Fed doesn't cut until December. So that really takes any of the news of the Federal Reserve, off the table. And, as you mentioned, tariffs and other issues are going to be front and center until you can translate and figure out how much and where and what the impacts will be based on companies and countries. The other thing, going back to the dollar, as you said, David, the Magnificent Seven, right? Many of those are flat to down on the year. And if you think about the strong dollar impact, right, the opposite of the international companies, many of our largest companies, more than half of their business is overseas. So you bring those weaker currency profits back to the U.S., it's a headwind, despite the strong economy, right? And this was a big impact in 2022. So it's something to watch for, on top of just relative valuation overall.
Yeah, so Jerry, you mentioned we talked a little bit about inflation. We can bring that up and take a quick look at and see, how that trend has changed. But as you mentioned the stronger dollar as well. I think with that and inflation, I guess the question is, do you see rates staying at this level or potentially moving higher?
Well, as the Fed has always continues to say, it's data dependent, right? So we're watching month to month. We had a positive inflation number a month ago, but now it's kind of ratcheted back up. Both CPI and PPI were much higher than expected, and it's really a trajectory. As you look at this chart, right? I mean, it looked like a little bit of dip, but then January's back up. And again, generally speaking, the tariff uncertainty, right now it looks like maybe some of those will start in April at this point. But as you're thinking about a business, you might raise prices now, not knowing, right, to protect and see where things go. And that could be very inflationary in the near term until find out what the actual news will or will not be overall. So it's definitely something to watch for. And if inflation really picks back up like this trajectory looks like in the short run, it could definitely be a challenge for the Fed of cutting rates at all this year and potentially, maybe look at a different cycle at this point.
So Joe, we talked a little bit about tariffs. I think that was a topic that has come up a number of times later into January and early February. So as far as impact of tariffs and what that could potentially look like, do you want to share some thoughts around, particularly with China or other areas, what that may end up looking
Well,
like?
if you look at China, right, there's been more or less 25% tariffs, for the last eight years or so, right? And one of the announcements was another 10%. And again, if you look at this chart, you could see the 10% tariff on China exports is 525 billion. China retaliated with a 15% tariff on 14 billion, right? And if you do the math, it's roughly 50 billion versus 2 billion. So you can see the challenge from China's perspective because of that very large trade deficit. It's hard for them to, really hurt U.S. consumers by the tariffs, right? On top of it, when you look at the appreciation of the dollar, you know, it's likely to have less of an impact than maybe worried from an inflation standpoint from China, right? So now the question will be, what does China do other than this? And they've kind of announced some investigations or some reviews or monopoly conversations on certain U.S. companies. And it could be stuff to watch for within there to see where China might pivot to outside of just tariffs. And when you go back, David, to interest rates, right? Let's look at housing, right? Housing has really started the year for the most part slow, despite the fact mortgage applications have been up the last few weeks, right?
Yeah, so you've seen mortgage applications moving higher, but the question is, are those mortgage applications driven by home purchases and activity that, creates economic benefit? So we've talked about this a number of times, right? If you are to buy a house and, or move somewhere else, ultimately you're gonna do some work on that home. You're gonna maybe paint something, replace some of the furniture. So that creates economic activity with all of the different support industries around housing. What we've seen is, an uptick in mortgage applications, but not as much activity in the purchase. So what that's really indicating is you have a lot of debt that is resetting. Some of the people that have maybe locked in a 5-year adjustable rate mortgage in 2020 are finding that that is moving a little bit higher now, or in many cases significantly higher. So you're having people refinance to consolidate some of their debt. You may reduce if your mortgage floats up to 7.5, but the market rate is 7 today. There's still an incentive to refinance, but it's not for what you would expect in a strong economy and not as positive overall.
Well, and again, the first priority is housing was not part of the first priority of the new administration. But as you said, you really need a vigorous housing market to drive kind of the breadth and overall U.S. economy, right? And refi activity, it is activity, but it's not the activity that's really going to drive GDP. So now as we turn kind of the outlook, maybe for the rest of the year and maybe a little beyond, there's an interesting research piece from Vanguard out a week or so ago and sort of projecting out the next 10 years, right? And we're talking this year. I think the general conclusion, whether it's this year or the outlook, diversification is back, right? And the concentration of, the largest companies driving all the investments or the majority of the investment results the last number of years, maybe that trend is over. And again, we mentioned this from Goldman Sachs had a similar research piece out a number of months ago talking about their prediction of a lost decade ahead from large cap companies. It was a simple math argument. If you're already 3.5 trillion and your PEs are very high, it takes years, potentially to grow into those valuations unless, the growth rate continues at the pace it has, which, is unlikely. But again, when you look at this Vanguard piece, bottom line, and the headline was Vanguard predicts bond market to outperform, U.S. stock market over the next 10 years. Right. You can kind of see the highlights in there. But the other interesting one is international. They're expecting higher, international returns than both bonds, U.S. bonds and U.S. stocks. So I think as we look at the landscape of where to go, what to do, diversification is key to all of this, whether it's within your fixed income portfolio, within your equity portfolio, that maybe the concentration of the big caps is slowing down. Again, we've seen that year to date. And I think as we look at the outlook, it's fairly consistent that you could see this play out, whether it's this year or a number of years ahead.
Yeah, it sounds like diversification, kind of like you said, remains important. I think, the other thing we talked about, whether you look back at a year like 2022, where there was a significant market downturn, having high dividend paying stocks, really supported portfolios and prevented larger losses. You had also the outperformance in bonds relative to US markets. So I think having safety and stability in the portfolio is important, but tying it back to financial planning, it's really making sure that you're covering the needs that you have and giving your portfolio the opportunity to grow into the future, to keep up with inflation, and also to take advantage of a market downturn. Because if markets move lower, interest rates, and bonds become an opportunity to sell and to rebalance into the recovery. So I think diversification, like you said, very important, but really tying it back to the financial plan, to making sure that you're on pace with your individual targets and you don't make changes to the portfolio because of anticipation of what the administration might do, anticipation of what inflation may look like. Those variables are very hard to predict, but trying to measure your expenses and really plan for your portfolio is much simpler and gives you a lot more clarity into the future.
As we recap and kind of look to the future, I think for the most part, the markets have been much more resilient than expected, given kind of the headwinds. And bottom line, the U.S. economy is on pretty good footing, and the trajectory looking ahead, kind of supports that. On the other hand, I think we all expect continued volatility within the markets around a lot of the tariff noise and such. But again, the key with a lot of that, interest rates are high, and you could take some profit and rebalance and look for a little more safety and stability if you're looking for that. Or on that stock market, there is still opportunity within the breadth and international. So with that, we're going to thank you for tuning in, and we'll touch base next month.
Thanks.